Assalamualaikum warahmatullahi wabarakatuh, and hi, my name is Mohamad Farizuan bin Abdul GHANI. I'm from class JBC 2423A.
Hi, my name is ABID UWAIS bin HASIM from JBC 2423A.
Hi, I'm NURDIANA QAMARINA binti ARIFFIN.
My name is FAEIZA binti Mohamad ZALIFODDin.
Hi, my name is ANIERA ALIEANA binti Mohamad ZANI.
Assalamualaikum and hi, I am Mohamad SYAHMI bin SAZALI. I am from JBC 2423A.
Today, my friends and I would like to present about the expectation theory and liquidity premium theory. So, let's start with the definition of expectation theory. What is the expectation theory? Okay, expectation theory attempt to predict what the short-term interest rate will be in the future based on current long-term interest rate. The theory suggests that an investor earn the same interest by investing in 2 consecutive 1-year bond investment versus investing in 1 2-year bond today. Okay, the theory is also known as the unbiased expectation theory. Okay, to understand the expectation theory, expectation theory aim to help the investor make decision based upon a forecast of future interest rate. The theory use a long-term interest rate, typically from the government bonds, to forecast the rate for short-term bonds. In theory, long-term rate can be used to indicate where rates of short-term bond will trade in the future.
I will explain about assumption in expectation theory. There are 3 assumptions in this theory. First assumption is market participant buy and sell securities in order to maximize profit. Second assumption is long-term and short-term securities are perfect substitutes. And third assumption, there are no transaction costs in shifting between short-term and long-term securities. To simplify the theory, we can simply say that short-term interest rate will determine the interest rate on long-term bond. To be more clear about this theory, I will give an example. We have 2 strategies. The first one is buy 1-year bond, and second one is buy 6-month bond and reinvest in the next 6 months. If we follow the first strategy, we will earn 10% in 1 year. In order to get similar yield using second strategy, we have to reinvest at 11% in order to get average of 9% plus 11% divided by 2 equal to 10%. This is because in this theory, bonds with different maturities are assumed to be perfect substitutes. Expectation return on both bonds must be equal. Otherwise, these 2 bonds will not be perfect substitutes. So, we can safely say that short-term interest rates are a portrayal of long-term securities.
NURDIANA QAMARINA binti ARIFFIN. I'm gonna present about the fact of expectation theory. There are 2. First, interest rate on bond with different maturity move together over time. The characteristic of interest rate is if they increase today, they will be higher in the future. Long-term rates are the average of expected future short-term rate, which means a rise in short-term rate will also rise long-term rates. It will make short-term and long-term rate to move together. Second, the yield curve tend to have an upward slope. This means when short-term interest rates are low and when short-term rates are high, they are inverted. To conclude, the pure expectation theory is by analysis using the demand or supply of bond and interest rate, which is higher short-term rate, will decrease demand for long-term bonds, and also reducing the prices and interest rate for the long-term bond will increase. Next, if short-term interest rate are expected to fall in the future, yield curve will be the descending type. Moreover, if short-term interest rates are expected to remain unchanged in the future, yield curve will be the flat type. Lastly, if short-term interest rates are expected to increase, then fall in the future, yield curve will be the hump type.
I will explain about definition of liquidity premium theory. Liquidity premium theory is a theory of the term structure of interest rate that view bond as imperfectly substitutable. So, yield on long-term bond must be greater than those on short-term bonds, even if short-term interest rate is not expected to rise or fall. It states that the interest rate on a long-term bond will equal to an average of short-term interest rate expected to incur over the life of long-term bond plus a liquidity premium. Bonds of different maturities are substituted, which means that the expected return on one bond does influence the expected return of a bond of a different maturity, but it allows investors to prefer one bond maturity over another. Investors tend to prefer short-term bonds. This theory combines elements of the segmented and the expectation theory. Examples of instruments that are liquid in nature would be stock and treasury bills. These instruments can be sold at any time, which can be prevailing market rates.
Assalamualaikum and very good morning. Today I am Mohamad bin SAZALI. Want to talk about assumption for a liquidity premium theory. Firstly is long-term securities carry a greater risk, which means the reason a longer-term bond carries a greater risk that higher inflation could reduce the value of payment as well as overall interest rate could cause the bond price to fall. Bonds with maturity of 1 to 10 years are sufficient for most long-term investors. Secondly is investors require greater return to invest for longer period of time. Being a long-term investor means that you are willing to accept a certain amount of risk in pursuit of potentially higher rewards, and that you can afford to be patient for a longer period of time. It also suggests that you have enough capital available to afford to tie up a set amount for a long period of time. That's all from me.
So, based on the definitions and assumptions that have mentioned by my friends previously, there are 3 facts that we can conclude from this liquidity premium theory, which are: fact number 1, interest rates on different maturity bond will move together over the time. For example, if the short-term interest rates increase today, then they will tend to be higher in the future. Fact number 2, when the short-term interest rates are low, the yield curve will tend to have a steep upward slope, and when the short-term interest rates are high, this situation will be vice versa. When interest rates are low, people will expect them to rise back. For the last fact, which is fact number 3, yield curve typically slope upward to address the fact that liquidity premium rise with the maturity bond due to the investor preference for the short-term bond.